Hey everyone, welcome back. And I'm glad you're here with me today because what I'm about to share could mean some actual breathing room for your wallet and a bit of stress relief for our seniors watching too. The Federal Reserve just gave a pretty big hint that they're planning to cut interest rates soon, and President Trump had a lot to say about it. But here's the twist, there's a piece of this story most people aren't talking about yet, and that hidden piece could affect your savings, your borrowing, and maybe even how safe you feel about retirement. So stick around because by the end of this talk, you'll know exactly what's changing and what smart moves you might want to think about next. Before we get into the nitty-gritty, tell me in the comments, how do you feel about interest rates lately? Do you feel like borrowing costs are too high, or are you more worried about your savings losing value? I'd love to hear your thoughts. And hey, if you find this helpful at all, please hit that subscribe button. It helps a ton and keeps this community growing strong. All right, so let's set the stage here. Right now, the Fed, which basically sets the tone for how cheap or expensive it is to borrow money in America, has been super cautious. They didn't cut rates last month, but hinted they might do a small cut later this year, maybe around 0.5%. Now President Trump, as you might have seen, is not happy about that at all. He's been calling the Fed chair Jerome Powell all kinds of names lately, saying he's costing us billions by not cutting rates faster. Trump wants big cuts, fast cuts, because it would save the government money on interest payments for our massive national debt. Plus, he thinks lower rates would help boost factories and American-made products, and maybe win him some points politically too. But here's the catch, and it's a big one. The Fed is looking at the numbers, and they're worried that cutting rates too much could actually backfire. Think back to the 1970s. If you remember, we got hit with crazy high oil prices and inflation shot up. The same kind of thing could happen now because of Trump's tariffs on steel and stuff we import from overseas. So the Fed is saying, hang on, we can't just flood the economy with cheap money if prices might start climbing again. And guess what? There's also this other puzzle piece. Trump's new tariffs and tighter immigration rules are pushing up costs for companies because there are fewer workers to do certain jobs like picking crops or building houses. When there's a worker shortage, wages go up. And when wages go up fast, companies sometimes raise prices to cover it. So yeah, more inflation pressure. So then, what does this tug of war mean for regular folks like you and me? Well, it's kind of mixed bag. If the Fed does cut rates, even a little, your credit card interest might go down a bit, and it could get slightly cheaper to buy a house or refinance a mortgage. Not a huge drop, but a bit of relief. Same for folks wanting a car loan or a small business loan. But here's the flip side. If you're retired or you like having money sitting in a savings account or a CD, you might see those juicy interest rates start to slip. Right now, some banks are giving you around 5% on a good savings account, which is pretty sweet compared to a few years ago. But if rates go down, so do those returns. For a lot of seniors, that interest is extra money that helps cover rising costs that Social Security doesn't always keep up with. So a cut could mean losing out on a few hundred or even a couple $1,000s of income each year, depending on how much you have saved up. Not fun when groceries and medicine keep getting pricier. Now let's talk about something I know many of you keep asking me about, the national debt and what that means for you. Trump argues that lower rates mean the government pays less interest on that $36 trillion debt mountain. In theory, saving billions here means more money for other stuff like Social Security or roads or whatever. But the reality is investors watch this debt like hawks. If they think the US is borrowing too much without a plan to pay it back, they demand higher returns on bonds, and that ironically pushes long-term rates back up. So even if the Fed cuts, your mortgage rate might not drop as much as you expect if investors get nervous. I know, it's a bit of a head scratcher. So here's what you can do. If you have a high-yield savings account, maybe lock in a good CD now while rates are still strong. If you're thinking about refinancing a mortgage, keep an eye on those bond yields, not just the Fed headlines. Sometimes people get caught off guard because they think one automatically follows the other, but that's not always true. And for seniors, maybe think about other safe ways to get some income if rates start slipping. Some people look at laddering CDs or even certain low-risk bonds. If you have a financial advisor, it might be a good time to ask about adjusting where your cash sits. Also, if you're wondering how all this could hit Social Security, it's kind of a mixed story too. The government paying less interest on debt sounds good, But big rate cuts could stoke inflation, which chips away at the buying power of your Social Security check. So the cost of living adjustment you get each year might not fully keep up if prices run hotter. Speaking of inflation, remember how we talked about the 70s oil shock? Well, today's version is partly because of those tariffs and partly because of tension in the Middle East. Israel's recent move against Iran pushed oil prices up fast, and when gas costs more, everything kind of does too. So the Fed is watching this like a hawk because they don't want to be forced to slam the brakes later and hike rates again after cutting them. That back and forth is rough on markets and households alike. So yeah, for now, think of the Fed's plan as a gentle tap on the brakes rather than flooring it. They're likely to cut a little, see what happens, and adjust later. Trump, meanwhile, is pushing hard for deep cuts because he wants to boost industry and cut the debt costs before election season heats up more. And next, one more piece folks don't always think about: immigration and labor. With fewer immigrant workers in the fields, farms pay more for labor, which means food prices can sneak up too. It's not as obvious as gas or rent, but over time, your grocery bill notices. So what should you do with all this info buzzing around? Well, stay calm, stay informed, and try not to chase headlines. If you're saving, maybe review your options for the best interest you can lock in. If you're borrowing, check if a refinance makes sense soon, because once the cuts roll out, lenders can change terms quick. And, even though all this rate talk can sound pretty complicated, just remember you don't have to tackle it all alone. Take a little time this week to check your savings accounts. Maybe call your bank or chat with a trusted family member about ways to stretch your money further if rates change faster than you expect. Small steps today can make a big difference down the road. So don't wait too long to give your finances a quick checkup. Also, share this with a friend who might be worried about their retirement nest egg or someone thinking about a big purchase soon. It helps more folks stay a step ahead. And hey, I want to know from you. Do you think the Fed should cut rates more to help borrowers or hold steady to help savers? Let's get a good chat going down below. I read every comment and I love hearing your takes. So to pull this all together, the Fed and President Trump are basically arm wrestling over how cheap money should be right now. Each side has decent reasons, but at the end of the day, you and I are the ones who feel it first in our savings accounts, our loans, and our monthly budgets. I'll keep watching how this plays out and bring you updates as soon as they land, so stay tuned. If you found this helpful today, please remember to subscribe, give this a thumbs up, and maybe share it with someone you care about. Take care of yourselves and your money, and I'll see you next time.